Let's head over to our screen now, and the first type of company we're gonna look for those type threes. If you remember, those type threes are the high yielders or the dividend aristocrats, maybe sometimes called the yield traps. So let's have a look. Now the really easy way to find a type 3 dividend company would just be to go for 6 out of 6 on the dividend score. We just saw earlier that those 6 checks, look at all those different factors, and frankly if you're meeting all of those, that's effectively a dividend aristocrat. And it's intentionally very difficult to meet all of those checks. If you look here, I've now dragged that out to be 6 out of 6, and there's only 245 companies worldwide that are meeting that. And in fact, if I go to some markets, so for example, if I go, we'll go to the US last. So let's go look at, say, Canada. So in Canada, 10 companies, right? That's not that many. Let's turn off Canada. Let's have a look at the UK. In the UK, 5 companies. And last time I checked, Australia had none. Yeah, no, there's not a single company on the ASX that's meeting those requirements. And let's go to, but there might be in the future. If you save a view, you'll get an alert. We'll talk about that in a bit. But going back to US, so US we've got 36, right? Companies meaning that. So that's a really easy way to start. But now let's go and understand the dilemma that we talked about earlier, right? With these aristocrats, you need to be so careful because so often you're giving up capital appreciation for dividends, and the easiest way to check for that would be to go in here and simply say, what did we say? US market 80%. Okay, so they have to at least have met the US mark. I think it was 81. They're all gone, right? You can see that. So you see what I did there? We went 6 out of 6 for dividend companies, and in the US there's there was still 20 plus. But now all I'm asking for is for those companies to have also matched the market over the last 5 years, and now we're down to 3. So you can instantly see the point that I'm trying to make in this video, that with these high yielding companies, you are often exchanging yield for capital gain, but not always the case. So let's take a look where that might not always be the case. Now the first thing is, these checks are all quite strict. So what we can do is we can take another approach at this. I'm going to reset and click here. I'm going to reset, go back to the beginning. Let's stay in the US market for now. And so now I'm going to kind of recreate what's behind the 6 out of 6 dividend checks, but I'm going to kind of do it manually just so that we can see the sensitivity. We can see how it builds up. So the first thing I'm going to do, I'm going to simply go and ask for, I would normally use forecast yield here, just to be clear. I mentioned earlier that it's really superior, but to get a forecast yield, you need analyst coverage. So for now, I'm just going to do the regular historical yield. And let's say I'm really looking for something that has over 7%, right? We're in the type 3 companies at the moment. So I'm going to go over 7%, and I'm also going to ask for total shareholder yield to also be over 7%. Why? Because I don't want to be diluted, right? I don't want to, sure, I can find companies that are paying 7% dividend yield, but they're diluting shareholders by 20% every year. So let's see where that lands us. Okay, so that's taking us down now to 100 companies. And by the way, I'm actually on the, I'm on the table view at the moment, but you can always swap to the tile view. The tile view, in my opinion, is much better when you don't know the companies, because I can just hover over each one and I can see what they do. It's much easier to see the snowflake. So the advantage, however, of the list view is that you get to see the dividend. So you can swap between them. Now, we can see we're 105 results, but all I've searched for is just high dividend. I haven't done anything else. It doesn't mean these dividends are affordable, right? Now let's also add that check in. Let's be a bit softer, okay? Let's not ask for 5 years. Let's ask for 3 years, okay? It's a bit softer. Let's say 3 years. Let's be kind of okay. Let's be okay. Let's say 30%. Okay, we're not being too strenuous here. again, it's the same thing. We've completely cut that down now from 100 to 12 just by asking for that. But you got to remember what I'm looking at is historical, right? It's historical. Now, that doesn't mean that in going forward that these companies might not perform. They might. Who knows? Maybe the share price is already rock bottom. But you can see the point I'm getting at, which is to find these type of companies really is tricky. And you really need to be, like I said, either being completely aware that I'm swapping that capital appreciation for dividend, or you can find ones that will pay a high dividend and will still do really well, right? But they're just harder to find, right? There really will be a gem, and the best way to make that decision, I'm going to show you later, which is narratives, because we need the company to still have some kind of value. Other things you can add here, again, we're being quite strict, so I might loosen this a little. I might, I like to keep this one, but let's just be a little looser because I want to get a nice list. Maybe I'm going to cut that down. 6% still pretty good. I can handle 6%. I probably also would want not like crazy payout ratios. So maybe between 0 and 80, like Damodaran always says, an established company will pay out 80%. So let's do 80% there. Okay, where is that leaving at? 8. Okay, so now we've got a completely new list there, because what I did is I relaxed the criteria a bit. I only wanted a 6% yield. Again, I'm kind of recreating those dividend checks myself there. And I've got a completely new list of companies that, again, I don't know these companies, but these are all high yielders, and these could all be ones that could be worth diving into. And last one, which I think is quite powerful to look at, again, is the risk score, right? A super risky company. So you could say, well, I don't want more than 1 or 2 risks. Let's say 2 for now. Does that make a difference? That does make a huge difference. And the real final one I would always think about is growth. Like I said, if you're going for a dividend company, you're not going for a crazy growth company. Cool, that makes sense. However, you can still ask for a little bit of growth, right? Just by dragging that snowflake again. That dilemma has appeared again. I can't have both. But you would want to sort of, that we can also go in here and we can also say, well, let's I at least want, for example, earnings to not be minus 30%. Okay, I at least want earnings to be growing 3%. Well, that doesn't sound too crazy. Again, we've lost, the dilemma has reappeared again. I guess that's the best thing about the Simply Wall Street Screener is, you can use it to explore. As I said, I'm basically trying to be completely transparent that this type 3 is a tricky one to find hidden gems, or to find something that matches that aristocrat characteristic, and it doesn't have the chance of eroding value. I do believe they're out there, just to be clear. And in fact, often some of these companies might move between the types, which I'm going to show you a bit later. So like I said, we've been through a bunch of filters there. I'll just reset, and I'll just say again, the really, really easy way to do that is just to do that. Okay, cool. I'm now looking for type 3s. And again, if I was to showcase another way to explain that type 3s, you can't have both. You have to deal with a dilemma. There we are. You can't have both. I can't have 6 out of 6 on dividends, and I can't have 6 out of 6 on future. You got to choose, right? I can start to soften these little, and maybe I'll see what I can get. Okay, cool. Now it's starting. I meant this is global, by the way, so don't get too excited. So I softened those off a bit. Now I'm getting some more results. But you see, I think I've made my point there.